Thank you, Vicky. Very, very kind introduction. Welcome back to your last session before lunch. It's your panel debate, so it's important that there'll be an opportunity for you guys to have some questions as well. We've got three very good guests here that we want to hopefully expand on the themes that we've picked up on today. The first question I'd like to start with is just around UK finance figures. So if we look at UK finance figures, according to them, the buy-to-let gross lending in 2021 was 45 billion. 2022, they're projecting it to be 40 billion, so we're talking about a 5 billion drop. So question to the panel is, firstly, what's your thoughts on the drop? And secondly, do you believe there to be any opportunities in the buy-to-let market for our audience? And Wes, if I can start with you, if you don't mind.
Thanks, Doug. Yeah, so this is the old crystal ball time, isn't it? And I think UK finance figures were actually published in December kind of time. So this is pre-base rate increase, pre what's going on over in Ukraine. So the world looks very, very different today than it did back in December. But having said that, drilling down within the forecast, it does seem to make sense because the drop-off is predominantly purchase. So last year we had the stamp duty holidays that were obviously fueling the purchase side of the market, and it's that is attributed to that drop-off. So that does feel about right. So this is probably going to be the year of the remortgage more so than the year of the purchase in general in the market, including the buy-to-let market. In terms of opportunity, remortgage is a big opportunity in this space this year. You know, we've got a lot of 5-year fixed rate products reaching maturity. So in terms of one big opportunity for the guys in the room, it's looking at your back books, looking at those customers that whose deals are going to be reaching maturity this year, and looking at the remortgage opportunities for them.
Okay, thanks, Wes. Marcus, your thoughts?
Yeah, I've got to say I totally agree with everything Wes said in that regard. Like the stamp duty, although investing in buy-to-lets is not supposed to be a short-term thing that people think about, that did actually drive the market quite a bit, with people looking to get in and take advantage of the stamp duty and the extension of that going forward in that 2021. I say the remortgage market is going to be extremely important. So going back 5 years when the sort of changes were made by the PRA, that is going to move the markets. There are a number of those 5-year fixes coming to an end now. So I can't disagree with anything Wes said. I think looking at a 5 billion decrease is probably quite a good thing. Don't want to be pessimistic, say it could even be less than that with all the changes we've seen around the world at the moment. So yeah, it's a crystal ball, watch this space type of thing, but we're all here to be in the buy-to-let market, so hopefully that continues going forward.
Have you got any thoughts on opportunities, Marcus?
Well, opportunities for us, it is about having a diversified portfolio in regards to the buy-to-let. So the more different areas, specialist areas you go into, there are opportunities there. I mean, I've been talking about holiday lets all morning, so it would be remiss of me not to say that that's an area of the market that will continue to grow. I do think holiday lets, there isn't a staycation boom that's going to continue to rise as sort of time goes on.
Okay, so whereas you're saying sort of remortgage is the growth area, and we're talking holiday lets as well, Marcus. Yeah, okay. Adrian, your thoughts?
Yeah, look, I think you can attribute a 10% over, we said 45 billion, potentially 40. That's roughly 10% uplift last year compared to what they're predicting this year. But I think, look, it's been a really busy first quarter. The fact that base rate has moved and fixed rates are going up is causing landlords to look at what they're paying. But to Marcus's point, the 5-year anniversary and the rate roll-offs from 5 years ago, the rates you can get today, in many cases, are still cheaper than what you could have got 5 years ago. Property prices have gone up, so it allows investors, if they want to capital raise, Doug, whether that be for home improvements, green mortgages and the such like David discussed earlier, and still get cheaper rates. I think year of remortgages is right, but don't forget those lenders that will look at maintaining clients on their book. PTs is going to be a big part, Doug, for people. A lot of those rates that come to an end, they will revert onto competitive rates with the lender they're with at the moment. And the beauty of buy-to-let is it's probably 95% intermediary driven. So all of those clients need advice on all of the bits that the two lads have said as well so far. I think the interesting bit going through the course of this year is getting to speak to your clients early, because you've seen how quickly these fixed rates have moved in the residential market. We're starting to see that in buy-to-let now. So the 5-year fixed rate you probably could have picked up in January is not as cheap as it is now as we sit in April.
Yeah. Do you see lenders, just talking of interest rates and the market we're in at the moment, do you see lenders helping and supporting brokers probably a bit better with all the product pools and probably trying to give us a bit more notice sort of going forward? Is there a way to get a good sort of customer outcome there?
Yeah, I think the swap markets have moved quite quickly, so there's been a lot of pressure on that. There's been a lot of pressure on lenders in terms of service. None of us are perfect. We try to provide a good service. I can only speak for ourselves. So when we recently repriced our Kent Reliance brand and our Precise Mortgages brand, we told people at 3 o'clock the day before that the fixed rates were the rates that were likely to be going up. And they had until 5 p.m. The next day to either get the apps on in Precise Mortgages or to get to the fees paid stage in Kent Reliance, because the two systems work differently. We also took into account the fact that our distribution model goes both direct to the broker and through the packaging community. And we allowed, obviously, I think it was a 2-week period for the packagers to get their cases in as well. So I think, speaking for ourselves, we've tried to be as fair and transparent and as clear as we can. But I think, the key is trying to give you guys as much notice as possible. But there is only a finite amount that you can give before you see a big spike in volumes of apps coming in that you then have to process.
Yeah.
Okay.
I was just going to go on the back of that. I think in the mainstream market, the prices do seem to kind of move a lot quicker and overnight. We work in particularly HCB, we're in the specialist market, so we've a lot of profit that we've actually built in. We can withstand that period of our prices are going up in X amount of days. We give you that time period to be able to put the applications in. I think we can actually withstand some of that rather than the mainstream market, which does seem to move pretty quickly overnight with price and removal of products from their offering. We don't seem to do that as much with us.
Okay. I think the problem is probably compounded by all lenders moving a number of times within a short period of time as well. Mm-hmm. So as a broker, you're feeling like you're getting it from all directions at the same time, but hopefully it will settle down in the near future.
Okay. Thanks, Wes. I'm sure we might get a question on that later when we pass over to the audience, shall we say. So can I just ask just a continuation? So we're talking about remortgage, the opportunities where there might be growth. So remortgage, holiday lets, etc. So have you got any thoughts on what our audience should or could be doing in order to capitalise on those market opportunities going forward? Wes, can I start with you?
Yeah, this is always the cliche answer, isn't it? Education. But I think if you know what the opportunities are, it's just genning up on those opportunities. So, for instance, we've seen an uplift over the last couple of years at Fleet in limited company applications. So if you're a broker that's active on the residential side of the market, the buy-to-let side of the market, but hasn't done many limited company type cases, then talk to us, talk to the other lenders, talk to the BDMs, upskill on that particular part of the market as well, the limited companies, because they are becoming more and more popular. That's one example of where upskilling and education will help, but you could apply that to anything. So today we've heard from Paragon around HMOs and all of the considerations there. It's just upskilling your own personal knowledge on the growth areas within the buy-to-let market, so that when your door does get knocked and you've got a client there with some questions, you already know the answers and who you can talk to get more information. Yeah.
Thanks, Wes. Marcus?
Yeah, and just off the back of that, let's say being in the specialist lender market, we can move things pretty quickly. So if the more feedback we get from clients and brokers about the themes in the market and what they actually need from us, we can actually change our products quite quickly to be able to then work with you on that. I think if there's an area of the market that you're not entirely confident on, then not just saying it because Doug's in the room, but the packages, they can actually help you with that area. So if you're not particularly sort of au fait with limited companies or holiday lets, then there are people out there that can help. But it's about talk to us, talk to your packaging firms, talk to anyone about what can come next, and I think that's going to be quite important.
Adrian?
Yeah, look, I think in terms of limited companies, we've just released under the Kent Reliance brand our tax guide in conjunction with EY. That's a good read if you to share with your clients as well. We made sort of substantial changes to the way in which we work as a sales team this year. We've dual branded the Kent and Precise guys so they can help you with different types of lending within those brands. And also we've opened up the product line, so we're seeing good demand for our bridging products, both through Precise and the Interbay range that's just been launched now. And you can kind of build on the company bit. So, through Interbay, we're able to do trading businesses. Through Kent and Interbay, we can do incorporation from sole name or personal name into a limited company. And it surprised me, actually, that this year already we're still seeing people looking to make the transition from individual name into a company name. So I thought most of that would have probably been done over the last 4 years. So there is still a big market out there. But the bit I'd encourage everyone in this room is that, we've all invested in our sales team. We've all got our sales team back out on the road. And they want to support you. Get the specialist BDMs in there because they're the ones that can help you with these tricky cases, right the way through from, as Wes said about limited companies. The guy from Paragon was talking about the HMOs, and as Marcus has been talking about holiday lets. There are solutions for all of your clients out there. So, get the BDMs in. There's a lot of them here today. They'll certainly help you with placing the case in the right place.
Okay. So hopefully some answers there. So I think use packages.
That was the one, Doug, yeah.
That was right, okay, I get you. Okay, so can we move on to the green agenda, if we could? And I just want to read this to you, and it probably just picks up on, Adrian, what you're saying about your EY report that brokers can use. Shawbrook Bank released a white paper that they, from what I can see, are comfortable with brokers using with their customers. So I just want to read something. I'll just give you a bit of backstory to it. In a recent report by Shawbrook Bank, whereby they analysed 1,000 landlords in respect of the proposed new EPC regulations, the summary findings detailed the following. 23% of landlords had property rated D or below. 27% did not know the EPC rating of their property. Bear with me on this. 15% were unaware of the proposed changes. 26% had little to no knowledge of the proposed changes, and 47% of landlords would like more guidance on the proposed changes. So my questions to the panel, and the first question, how are buy-to-let lenders adapting their product offering to suit the green agenda, and what product innovations could you envisage? Wes, can I start with you on that one?
Yeah, so I suppose the first question is relatively easy. So the Fleet don't currently have a green mortgage proposition. So I've been keeping an eye on what the other lenders have been up to. And I think so far, correct me if I'm wrong guys, but I think the products are currently designed to reward the investor that's buying a property that's A to C already. So that's great, that's a start point. That's direction of travel is correct, moving in the right direction. But it doesn't necessarily help all the housing stock out there that's doing below at the moment. Yep. So I think the products out there are great. The customer's getting a better deal, lower costs for them, but it's not actually impacting our carbon footprint as a country, as far as I can tell at the moment. So I think that's probably the direction of travel and innovation needs to move into that space. But at the moment, the products themselves are very much just rewarding people that are purchasing those younger properties, new builds, A to C rating, or maybe even just A to B on some product ranges, rather than actually improving the situation, dare I say.
So you're talking about assisting landlords that are not ABC, basically, bring the Ds and the E's.
Yeah, so I think really the spirit of the legislation is really to improve the stock that's out there. Yeah. The younger properties, the new builds, are obviously in a good place anyway, in theory. I mean, you hear some horror stories about new build properties, but in theory, they've got the insulation, they've got the mod cons, they've got the ground source heat pumps, potentially things like that already. The first percentage you gave there, Doug, about 23% of properties are D and below.
Correct.
That feels really low to me.
It does, yeah.
Looking at our book, it probably begins with a 6, the percentage that are D or below. Yeah. So maybe if this is a survey of landlords, that tells me that landlords might not actually really know what their EPC certificate rating is. So that's probably a good place for them to start, figure out where you're at. And as we said earlier, obviously, you don't want to be fixing potentially into a 5-year fixed rate deal at the moment if you're going to need to be improving that property in the next few years for whatever reason. So that's another thing to consider potentially with some of these deals.
Yeah.
Thanks, Wes. Marcus?
Yeah, no, look, you're exactly right. We've had a lot of conversations on the green agenda and where we want to go with this as a lender. I do think we all need to play our part, us as lenders, yourselves as broker, clients, in making sure that we do actually move these products forward. There are a lot more options out there, but as you say, below C, there doesn't seem to be many. Now, we've looked at different things that we can do in regards to giving people sort of cashbacks on valuations if they improve the properties from an E to a C. We're looking at obviously the rules and regulations around that. We've actually got a product that we can just repackage, which is what's called our refurb in term, which effectively gives you 3 months to do the work on a particular property on our buy-to-let rates. So that may take your property from a D to a C, because there isn't actually a lot of work that you need to do, as long as it's pretty light in terms of the refurb, insulation, new kitchen, new bathroom, piping work. As long as that property was habitable at the beginning, you've then got 3 months in which to do the work. So we're going to try and actually rebadge that up and actually give people better cashbacks for actually doing that work, and encourage more and more people to improve their properties as time goes on. So it's about, again, rewarding people for actually moving it from outside of the criteria into. That's what we're actually going to try and do, and launch those in the next sort of coming weeks.
Right. Just on that point, just check my understanding. Are you saying it's a term deal from day one?
Yeah.
As opposed to a bridge to a term?
Yeah, correct.
Right.
It's a term deal day one. Now, we are looking at bridge to term as well, which is a lot more work.
Yeah.
But this is what I'm talking about within term. Our refurb in term is just really light refurb. So yeah, it's a property that's probably quite tired. Maybe an elderly person has lived there all their life and it needs a new kitchen, new bathroom, paint job, rewire job. That is within our term product, and we can do that now as we stand. It's just not badged as green currently, but it is, for every sense and purposes, a green product.
Thanks, Marcus. Adrian, your thoughts on product innovations?
Yeah, look, I think I probably echo what the two gents said there. I agree with Wes. I think there is a bigger proportion of properties that don't fit A to C than come out in the report that you mentioned there. I think Marcus raises very valid points that there are solutions out there already for improving properties that are not badged as green mortgages, as they are in some of the A to C ones that sort of David spoke about earlier, where people do further advances or they're doing remortgages and they're capital raising for improvements to their property. They may be quite often used for improving the energy efficiency in that. I think the real important bit for when you're speaking to your clients is the tools that are at your disposal to show them what their current ratings are and what their current ratings to get to. And I would ask everyone in this room to familiarise themselves with some of the things that are on the web, or indeed the barcode that David has on his stand down there. So, but this is a very key agenda, and it's a kind of one where it should be, we're in this together rather than racing against each other as lenders. But I think the agenda will grow and will grow. And there will be more innovation, Doug. You will see more lenders offering different products and propositions in this. To the point Marcus made, it may well be that you've got short-term funding into term where you can evidence it at the exit of that the improvements have been done. So this is going to be a fast-moving part of the market, particularly for buy-to-let. Do
you think we might see the return of a retention on a term deal? So, for example, it's a D to start off with, it's a 100,000 purchase price.
It's almost like the light refurb deal that was around a few years ago through one of the mainstream lenders. So yeah, look, I think you will see people start to become more, or lenders start to become more innovative and start to look at those properties that need the improvement to get up to, as Mark said, from a D to a C, which in theory, I think the average cost was about £11,000 to do those works. Yeah. you will get some people that will choose to exit their investments because the cost is too much as well. So remember, we've got to remember when we talk of a buy-to-let, it's an investment, it isn't their home to live in. So there will be some that will go back onto the market. And, to another point, you may see landlords look at a different type of investment, like new build going forward.
Right, interesting. Okay, so just to qualify the report analysed the landlords back in November of last year. So there's obviously been a lot of, this is the Shawbrook report, so it's obviously been a lot of news articles around the green agenda. So just staying with that, and a couple of you have touched on this, but what do you feel the key stakeholders within the buy-to-let mortgage chain, including the audience, could do to help landlords with the proposed changes? And bear in mind, I know David alluded to this in his presentation, that these are proposed changes, they're not law as yet, but what sort of things should we be thinking about?
And I think there sits one of the bits that the report probably highlights when it says, are some landlords unaware? They're waiting to see if this becomes law. I think I have a personal opinion on that, but I think that all we can do as lenders and brokers, and as I said, 95% of these clients that are investors come through you guys, is to highlight the changes that are coming along the lines. I would also highlight the pricing that's available at the moment, because there's no guarantee in, I can't predict where interest rates are going to go in 2 years' time, but fixed rates are probably quite good value for money, and some of the products that are out there at the moment, if people wanted to capital raise to do the improvements now, are probably quite good value.
Okay. Wes, anything?
Yeah, I think that was probably the standout stat from that report, was just the lack of awareness. And I think the more professional landlords are probably the landlords that are aware, and it's the the semi-professional landlords that may have one or two properties that aren't aware. So what the guys in the room can do is start those conversations. The earlier the conversations are started with your customers, the more time you've got to plan, prepare and get things in place. Aid's right, David earlier, these are proposed changes. When I joined Fleet last summer and I knew we'd be talking about these kind of things, I trawled the internet trying to get my head around what are the changes. Are they already in place? Are they, proposed? It was really tricky to actually pin down exactly what was going on. And it's only over the last few weeks that I feel like I've got a good grasp myself as somebody within the industry, let alone a landlord who's not looking at this every day of the week. Start the conversations with your customers now, and just bear in mind that 2025, the back end of 2025, we found out, probably 2026 and 2028 to 2029 are probably going to be quite important dates for them to keep in mind. And get those plans in place now, really.
Yeah, but again, it's have a conversation with your customer, but have a conversation with us, because as we've all alluded to, there are products that are there right now for you to be able to take advantage of the offerings that are out there. And even on the retention, looking at things on a case-by-case basis, there may be a scenario where a retention is just taken in a product that isn't badged as retention, but we'll do it anyway because it makes sense for that particular case and what that particular client is trying to do in terms of the growth in that property. We want better properties in our portfolio as well, so if you're going to improve it, then come to us even in term and have a conversation about what it is you're trying to do. We may even be able to help. It's about open and honest conversations about what you're trying to do. Don't just do it without permission, I would say.
And I guess it would help us if all the sourcing systems jumped on and helped with the green source, which would be good. David mentioned it in his presentation. There's a couple that are
I think
lagging.
He highlighted them all in his presentation.
Well, he did to be fair. I think he named them, shamed them, to be fair. But it's more, I think from that, I think it's important what the sourcing systems do bring to the table have to be fit for purpose for us. There's no point just having a green filter. That's not going to help, I don't think, brokers. So it's something to be aware of. So just at this stage, a bit of audience participation, if I could. In the last 3 months, when you've sourced a buy-to-let mortgage inquiry for your clients, how many of you have used the EPC checker on the government website as part of your research? So last 3 months, show of hands.
Wow, that's a lot. Impressive.
What's that, 20, 30%?
I'd say more than that, Doug.
Yeah, okay.
Half?
Probably 50%. There we go. 50. That's good. And the reason I asked that question, just coming back to the point from the Shawbrook report, is those that have used it, it's a fabulous tool. You know, it's there, you can find a lot of information out. We're actually seeing a lot of brokers now that we're talking to are using it as a tool to analyse a client's back book as well, their current portfolio, not just assessing the current one, to then share it with the client. And the point I'm making is if you've got 27% of landlords, according to Shawbrook's report, that do not know their EPC rating, and 47% of landlords want more information, then that's maybe our world that we need to be trying to highlight and move forward on. Okay, so any questions from the floor at this stage? Who's brave enough to put their hand up and chuck a question at the panel? Richard. Can always rely on Richard. Richard's a man. Thanks, Richard.
Hi, everybody. So on that subject, let's say, keep it vanilla, every broker in this room in the last few months has done a 5-year fixed. What happens when a lot of those buy-to-let properties are D&E? Is the lender going to call in the loan when it stays D&E in 5 years' time? What's going to happen?
Who wants to pick that one up?
Yeah, from the first perspective, I wouldn't say we'll call in loan. I think that was going to cause us more problems than it wouldn't if we actually kept them on board. But again, at that stage, it's about having a conversation about what it is now that we've got that can actually help you get it from a D to E to a C if the rules do come into place. But again, it's just about those open and honest conversations. But certainly not calling in any loans, because at the start of the transaction that wasn't something that we stipulated, so it would be a difficult one to call it in at that point.
I think, Richard, some of the feedback we've had from landlords that we do, and this isn't every landlord, is they have the cash and the means to do the improvement within the period of the term as well. So I think the important bit from advising a client or talking to them is, and you know, obviously 50% of people using the tool on the government website is fantastic, is your property's at an E, potentially by 2025 it might have to be a C. Consider that in the product that you're taking. But I think, as I said, you know, we've seen a lot of our larger portfolio landlords recently, because we set up this high net worth team. They were all aware of the changes coming down the line, and actually some of them came to the meetings with actually a listing of how their properties are already graded. So, yeah.
Perfect. Is that all right, Richard?
Gentlemen, yeah.
Stephen?
What are you doing with people whose EPC ratings are F? So you say you can't answer what you're going to do in a few years' time, but you can tell us now whether or not you'll facilitate a product transfer for those people.
I didn't quite catch all of
Just, so,
It's an F.
just say that again, Stephen, sorry.
If it's an EPC of an F, Doug,
Yeah, EPC of an F, yep.
will they facilitate a product transfer now? I
there
know
you
they
go.
shouldn't be renting it out.
Yeah. So will they do a PT?
Yeah,
if it's
because
a,
that
if
will
it's
tell
a-
us what they're going to do in the future.
Yeah, we allow our PTs going through at the moment. Not every lender, Stephen, as you know, offers PTs, and I think there lies a bigger question for some of those that don't.
And not every lender pays a proper proc fee for PT.
Yep.
So, anybody else want to add to Stephen's question? I think it's a fair point, because at the end of the day, if it's coming to the end of a product, if you're doing a PT, if it's a D, a C, or an E, or whatever, are they going to allow it? Basically, yeah.
We allow it at the moment. I mean,
Yeah.
you can't say where you are in 2 years' time, can you? Or 3 years as it will, but it will come around quite quickly. But at the moment, our PTs, with a PT offering, they can take it at the grade of the property.
Okay.
Yeah, I was going to say the rules aren't in place right now, so where we currently are, yes, that's not a problem at all. But should that change, we'll have to have that conversation at the time. But yeah, open and honest conversations.
With regards to
We've got one
the
more.
question just asked, if it's an F, it should have an exemption, and the rulings are that as long as the cost of moving it from F to E or above is less than 2,300, then it'll get an exemption certificate. Won't there just be more exemption certificates?
Yeah, that is true. I think it's £3,500. If you've spent up to £3,500 and you cannot drag that rating up any higher, then you get an exemption.
That includes your VAT, as I understand it, but I think that could be going to 10,000, that cap,
Yeah.
with the new.
This is a brilliant point, right? Because these proposed changes, bringing everything to a C, I've not found anything around possible exemptions or similar rules to what we've got now. If you spend a certain amount and you're still at a D, then do you get an exemption? So this is where we need the detail. All of us in this room need the detail really to understand where we're going to be in 2025 and 2028. But yeah, you're right. If it's an F rating today, in theory, it should have an exemption. The owner should have already spent £3,500 trying to improve that property.
Including that.
Including that.
I think what's interesting is that we're talking to our landlords about these concerns, and that's the key, is that we're talking and communicating with them. And
I think the great bit is people like this gentleman and the knowledge they have of it already. Yeah. A lot of the landlords are not going to have the knowledge that you've expressed there. And I think that's where the advice and the advantage of having a broker dealing with this is going to come to fruition.
Yeah. I think the only warning I say is it's not law, so you have to be careful that you're not saying you need to be doing this, because it's not law as yet. But if they want to get onto the green agenda, then it's something to be aware of. Okay, we'll move on. There will be opportunity at the end for a question from the audience. So the start of the year has seen a more bullish approach from buy-to-let lenders as they compete to win business. There are also inflationary and interest rate headwinds to navigate. So questions to the panel. How will buy-to-let lenders remain relative in the current market? Wes, first for you.
Relative in what sense, Doug?
Well, relative insofar as, so there's more competition.
Yeah.
Everyone's sort of going on the price piece. Is there angles that lenders need to be thinking about from a product innovation point of view? Do they need to be looking at their service proposition?
Yeah.
Is how do you remain relative in this market?
Well, I think last year, speaking from Fleet's point of view, last year prior to the Starling acquisition, it was predominantly about service for us as a lender. So we were winning business because of our quick turnaround times when other lenders were struggling under the weight of the volume that was coming through the system. We managed to maintain our SLAs at around about 24 hours throughout that whole period. So I think for us as a lender, keeping Fleet relevant, service is a big key thing going forward as well. We can potentially play the price game a bit better now as well with Starling's acquisition. We have access to cheaper cost of funds, so you'll see us creeping up the old pricing tables. I think we're around about mid-table at the moment. So it'll be that combination of very good service, decent costs, but also the flexible criteria as well that the specialist lenders are all famous for, really. I think each specialist lender has got a niche to fill and areas of the market where they are very good. And there's probably enough business out there for everybody, but it's going to be an interesting 12 months with a slight contraction in the market and a lot of lenders in this space. It will be interesting to see how we all fare.
Yeah. Just stick with that, Wes, because I think you guys launched a 7-year fixed recently, did you?
We did, yes.
Yeah, okay. Yeah. So have you seen an increase in the number of fixed rates, i.e. 7-year fixed, 10-year fixed? And is that something that's appropriate from an audience point of view? Do you think are you seeing an uptick in that market, and how big a market share do you think it is?
Brilliant question, because we don't honestly know. Hence why we've released the product.
Right, okay.
This is genuinely, to be honest with everybody in the room, a finger in the air scenario. And we were reaching out to our brokers and asking you guys that exact question. How big do you think this market is potentially? The 7-year fixed, the longer fixes. Is it something you feel your clients could potentially benefit from? Is it something you're comfortable to discuss and advise on and talk around? It's still very early days for Fleet. I think it's about 2 or 3 weeks ago our 7-year fixed products came out. We've not seen a tidal wave avalanche of 7-year fixed applications come through. 75% of our applications since the start of this year have been on the 5-year fixed rate products, so the vast majority. But watch this space. I personally think there is a time and a place for them. I think our products are priced accordingly to at least introduce them into the conversation. They're not priced out of the conversation. There are going to be clients out there, customers out there that will benefit from that setup, but I don't think it's going to suddenly be half of the market overnight or anything like that.
Well, let's get some feedback for you now. Who would recommend a 7-year fix to a client? Hands up.
That's why we haven't launched
There you go.
one.
There you go, Wes. Right, okay, we'll move on.
We'll pull him off tomorrow then.
Yeah,
24 hours notice.
Well, it's just, you might as well get the feedback
No,
while it's
but
here,
it is true that there are plenty of conversations had in the office about them. But we don't launch anything, we don't change criteria unless we've actually got that feedback. And we've asked a number of brokers of packages and said, is this something that you would actually want? And the answer, as within the room, is generally, 7 years is a bit too much. I think we'll stick with
Have a
5.
7 year with a 5-year break clause.
Innovation, right?
Well, that's probably the answer. 5-year ERCs.
5 years.
Yeah.
There we go. Right.
That's probably the answer.
Well, it brings on other. Right. Okay. So I just want to come back, Marcus, if I could, on the how do buy-to-let lenders remain relative in the current market. So you and Adrian, just your thoughts on that.
Yeah, look, service is the number one. We can all pull the price lever we can certainly pull the price lever from time to time, but if it's a race to bottom on price, us as a business, we don't need to win that particular race. We're about criteria, about helping you through solutions on a case-by-case basis, having a conversation with us about what it is that you're trying to achieve and trying to do. There are certain cases that, yes, we might tweak the price to win it, but if we have to do that on every single one, I suggest we're not going to be very profitable by the end of the year. So I can hit all the sales targets in the world. If we're not making any money, I don't think I'm going to have a job for much longer. So we do need to work with service, make sure that we look at all of our technology. Can we do things quicker? That's what it mainly comes down to. It's not just a race to bottom on price, because none of us will win in that circumstance.
Seems to be a race upwards at the moment on the price piece. Adrian, your thoughts?
Yeah, no, I mean, the guys have touched on service, I'll touch on support. You know, we've probably got the biggest sales force out there in the specialist market. We've rejigged that to provide better support to brokers. We've invested heavily in telephony to support the guys that want better telephony support and live chat support and web support. I think we offer, through our 3 brands, a wide range of products that can help everyone out, whether it's the quick decision through Precise, a yes or no, that more personal touch, the manual underwriting, the creative, looking at a deal for the more grey area in Kent Reliance. And our Interbay brand goes from strength to strength, whether that's looking at the commercial and semi-commercial stuff, which landlords do have, to the very big portfolios that need sort of proper bespoke tailoring and pricing. So, how do you remain relevant? To Marcus's point earlier, we listen to feedback from brokers and we try and work with that feedback to provide a good service and support to you all.
Thanks, Adrian. Okay, I'm just mindful, we've got another 10 minutes. I want to ask, see if the audience has got another question, but I just want to, just a couple of questions which I'll combine together if I could. What are your thoughts on where interest rates might be by the end of 2022? And also, what do you believe the gross buy-to-let lending figure will be for 2022? So, Wes.
Good question around interest rates. I think I did read a story at the back end of last year that said that by the end of 2022, rates will be around about 0.75, and we're there now. And that particular story also mentioned a worst case scenario of rates by the end of 2022 at 3.25% if there was, and I quote, an energy sector shock. Right. So this is pre-Ukraine.
Always the bearer of good news.
Yeah, right. So I think the short answer is they're probably going to be higher than they are today, Doug.
Yep.
I couldn't tell you exactly how much higher. The world's a bit of a crazy place, but I'd be very surprised if we're sat here at the end of this year and it's still 0.75% base rate. So in terms of rates, for us as lenders, we've got bank balance sheet funded lenders, capital markets lenders. Obviously, we're probably going to see that uptick this year that we've seen already, a little bit more. Hopefully it will calm down, and the movements aren't quite as quick, so I can't even keep up with them myself. But yeah, I think by the end of this year, or by this time next year, we're going to be looking at a slightly higher rate situation than we're sat on today.
And gross buy-to-let lending, you think, this year?
I think, the UK finance forecast, personally, as a relatively newbie into this part of the market, feels about right. The 40 billion gross lending, I mean, from Fleet's point of view, and to echo what Mark said earlier, it has been a very busy start to the year. It feels like actually we're slightly ahead of where we were last year at this point. But I can only speak from Fleet's applications point of view there. So yeah, the UK finance figure, 40 billion gross lending, feels about the right kind of size to me personally. Okay.
Wes, thank you. Marcus, your thoughts, interest rates, buy-to-let lending?
I feel like I'm just going to echo everything you said there in that sense. I'm no economist, so I'm not going to know exactly where it's going to be, but I would go on record and say I certainly think it's going to be higher than where we are now in terms of interest rates. There's a lot of backdrop to making that decision. Obviously, inflation, we're at the highest level we've been for 30 years. They do have to keep an eye on the number. It's not going to make life easier for any of us in regards to those that want to borrow. But savings obviously are better when obviously interest rates are rising. In regards to where I think the market is going to be, again, around the 40 billion mark seems to be about right. It will come off from where it was last year for all the factors we spoke about earlier in regards to the tailwinds that we had. But around 40 billion seems about right. And even at that level, like I say, I think there's enough business for us all to have another really good year and be very positive about the sector that we're all in.
I mean, Q1's been punchy for everybody, I would suggest, in the buy-to-let space, which has been for the lenders as well. You know, if that's replicated 4 times, it could be more than 40 billion, isn't it? Yeah. You know, over the next 4 quarters. Yeah. But it's whether or not it's going to be replicated, I guess. Okay, Adrian, your thoughts?
Yeah, 40 billion's a good year. Let's not make any bones about that. If we hit 40 billion, for those of us who were around in 07, 08, 09, would definitely take 40 billion. That's me and David Whittaker probably, and Doug. But, you know, I think that's a good year, and I think, you know, a lot of these rate rises could pull forward decisions for landlords that may have sat on variable rates or may not have wanted to take out a new rate just yet. So I think that's a good year in terms of business, and as Marcus said, plenty to go around for brokers and lenders alike. You know, base rate isn't going to go down anytime soon. So where will it be at the end of the year? Personal opinion, probably a good bit higher than it is today. But those of us who remember before the credit crunch will remember base rate used to be high then.
Mm-hmm. Thanks, Adrian.
And we survived.
We always survive. Any final questions from the floor? Yes, hand up. Una.
Hi, it's Chris Yates. With interest rates rising, do we expect stress test rates to rise?
Good question.
That is a good question. So, I mean, the majority of things, I guess, products Wes touched on his share of business on 5-year fix is against pay rate, and you would stress against that rate going up. I mean, I don't think too many people go variable. I often say the quote, not all regulation is bad, and I think with the PRA regulations about how you had to stress it, you know, depending on your tax position or the type of property that you had, is good protection for this sector. I'd probably be a lot more worried about those lenders that allow people to come in and stress at 100%, and that's some of the lenders that aren't regulated by the PRA. And I think, you know, clients that go into that position where people are doing it like that may have to look at things with a health warning as in a rising interest rate environment.
But it's at the pay rate anyway, generally, on the 5-year fix?
Yes.
Yeah, correct.
Chris, does that answer your question for you?
Not really, because if we're not doing a 5-year fix for whatever reason, a lot of the main lenders are using stress test rates of 4.5 and 5,
Yeah.
and 1.25 or 1.45 over that. But that's how it's been for some time. But interest rates are rising, so I'm just concerned.
There is quite a lot of headroom there, though, Chris, compared to where rates are. Even if you're doing outside of a 5-year fix, it's 5.5. That's quite a bit of headroom at the moment to where rates are going. But I take your point, and we, as lenders, we will be guided by the regulator in that if they put. For those of us that are, you know, 3 of us are all funded by banks, so you know that will come from a regulation point of view.
Because again, that might be a good reason why you would look to capital raise now or remortgage now, as opposed to leave it in case that rate gets worse.
I think as all responsible lenders, obviously, you need to check that their clients can afford the mortgage repayments. So it's definitely going to be something that comes into the crosshairs, I think, in the future, Chris, to be honest, how these are stressed. But interestingly, on residential mortgages, Bank of England recently said they're looking to remove the
5-year
rate stress as part of the residential affordability assessment. So it's interesting because they could obviously see where rates were going and how that would have an impact on people obtaining their own personal residential mortgages. So it might be that we see shift in regulation potentially as time goes on. But as Aid says, there's plenty of headroom at the moment. We tend to use pay rate for most of the deals, but as responsible lenders, it's going to be something we're all looking at.
You're also doing it at 125, 145
Yeah.
So that there is quite a good, good coverage in terms of that. As I said, it's the ones when I see people advertising on things like LinkedIn saying, we've done a deal covering at 100% of the pay rate. That's where I would worry a little bit more.
Thanks, guys. Thank you, Chris. Okay, so I'm mindful time is moving on. Final question, and if you could keep your response to 60 seconds. What message do you want to give the audience to take away with from today? Wes, you first.
I think the main message is there's plenty of opportunities. If you want to know more about them, then you need to speak to us, everybody up on the panel today, and all the other lenders in the other room. So get those contact numbers, get your local BDM's details, get them booked in, have these conversations, and it will better arm you to go out and speak to your clients about the opportunities within this sector.
Thanks, Wes. Marcus?
Yeah, again, to reiterate about education. Come speak to us, speak to your packages about the products that we can actually use and innovate going forward. It's about all of us working together to create a better environment for this particular sector that we're in. So yeah, educate yourselves to educate us to then get better solutions for you all going forward.
Thanks, Marcus. Adrian?
Keep doing what you're doing. I mean, I'm just super impressed with the knowledge in the room and the questions that we've had today, which tells me, no surprise, brokers are on top of what they're doing and on top of this market and helping their landlords get the best outcomes that they can.
Perfect. Thank you, guys. Thank you for the questions. A round of applause, I think, for the guys, if we could.